There is an organization that sets the interest rate on your mortgage, determines how expensive your car loan is, controls how much money exists in the American economy, and has done so for over 100 years. Most Americans assume it is a government agency. It is not. It is a private-public hybrid, whose member banks receive annual dividend payments from their ownership stake in the system. And the decision to create it, made in 1913, was one of the least publicly debated financial decisions in American history. In December of 1913, during the final days before Congress recessed for Christmas, a piece of legislation passed that would reshape the American financial system more fundamentally than almost any law before or since. Most members of Congress had already left Washington. Those who remained voted on a bill that created an organization most Americans would spend the next century misunderstanding. The Federal Reserve Act established an institution that looked like a government agency, was given government-like powers, but was structured in a way that gave private banks a permanent ownership stake and a guaranteed return on that stake in the form of annual dividend payments. Here is why this matters to your financial life right now. Every interest rate decision the Federal Reserve makes ripples directly into your mortgage payment, your car loan rate, your credit card APR, and the returns on your savings. When the Fed raises rates, your adjustable rate debt becomes more expensive. When it cuts rates, asset prices rise. And as we covered in our earlier video on rate cycles, those gains flow first to people who already own assets. The organization making those decisions that affect hundreds of millions of people's daily financial lives, operates with a structure of accountability that is fundamentally different from what most people assume when they hear the word federal. By the end of this video, you will understand exactly what the Federal Reserve is, how it was created, and why it was structured the way it was, what its actual ownership and accountability structure looks like, and why the question of who controls the money supply is one of the most important financial literacy questions almost nobody asks. Let us start in 1910, 3 years before the Fed existed. To understand what the Federal Reserve actually is, you need to understand the conditions that created it, and specifically, who was in the room when the idea was designed. In the late 19th and early 20th century, the American financial system experienced a series of severe banking panics, bank runs, where depositors rushed to withdraw cash simultaneously, triggering bank failures that spread through the system, were a recurring feature of the economy. The Panic of 1907 was particularly severe, temporarily freezing credit markets and threatening economic collapse until a group of private bankers, led by the most powerful financier of the era, organized a private rescue. The episode demonstrated two things simultaneously: that the American banking system was dangerously unstable, and that the people best positioned to stabilize it were the major private banks themselves. What followed was a process that has been documented in detail by financial historians. In November of 1910, a group of the most powerful bankers and financial figures in America traveled in secret, using fake names and traveling separately to avoid recognition, to a private island resort off the coast of Georgia. They spent 9 days drafting what would become the framework for the Federal Reserve System. The participants represented an estimated 1/4 of the world's wealth at the time. The meeting was kept secret for years afterward. When it eventually became public, participants confirmed its occurrence and its purpose. The legislation that emerged from that process, refined over the following 3 years, and passed as the Federal Reserve Act in December 1913, created a system with a specific structural design. A Federal Reserve Board in Washington provided government-appointed oversight, but the actual operational structure was built around 12 regional Federal Reserve banks. And those regional banks are not government agencies. They are corporations. Their stock is owned by the private commercial banks that are members of the Federal Reserve System. Those member banks are required to purchase stock in their regional Federal Reserve Bank as a condition of membership, and they receive a fixed annual dividend on that stock, currently 6% for banks above a certain size threshold. This structure was not an accident. The bankers who designed the system at the private island meeting had strong incentives to create an institution that would provide the systemic stability they needed, currency elasticity, a lender of last resort, while preserving significant private bank influence over the institution's operations and governance. They largely succeeded. The result is an institution that has genuine government characteristics. Its board of governors are presidential appointees confirmed by the Senate, alongside genuine private characteristics that make its accountability structure unlike any other institution that exercises comparable influence over the daily financial lives of ordinary Americans. Now let us be precise about the structure, because the Federal Reserve's hybrid nature is genuinely complex, and understanding it clearly is more useful than either the "it is fully government" or the "it is fully private" oversimplification that dominates most public discussion of the topic. The Federal Reserve System has three structural components. The Board of Governors in Washington is the most government-like component. Its 7 members are appointed by the President and confirmed by the Senate for staggered 14-year terms. This is a genuine government structure with genuine political accountability, though the long terms and staggered appointments are explicitly designed to insulate the board from short-term political pressure. The board sets reserve requirements, approves interest rate changes proposed by the regional banks, and supervises the overall system. The 12 Federal Reserve banks, in cities like New York, Chicago, San Francisco, and others, are the second component. These are the institutions with the hybrid structure we described. They are federally chartered corporations. Their presidents are appointed through a process that involves their own boards of directors, which include representatives of the private commercial banks that are members of the system, subject to approval by the Board of Governors. The New York Fed, which conducts open market operations and is the Fed's primary interface with Wall Street, is widely considered the most operationally powerful of the 12, and its president is a permanent voting member of the Federal Open Market Committee that sets interest rate policy. The Federal Open Market Committee, the FOMC, is the third component, and the one whose decisions most directly affect your financial life. The FOMC consists of the 7 Board of Governors, the president of the New York Fed, and 4 of the remaining 11 regional Fed presidents rotating on an annual basis. This committee meets 8 times per year and makes the interest rate decisions that ripple through every mortgage, every car loan, every savings account, and every credit card in the country. Now, here is the accountability question that matters. The Board of Governors is accountable to Congress. It must report to Congress twice a year and can be questioned by congressional committees. But the Federal Reserve's monetary policy decisions cannot be overridden by Congress or the President in the short term. The institution was specifically designed with operational independence, the idea being that monetary policy should be insulated from the electoral pressures that might lead politicians to prioritize short-term economic stimulus over long-term price stability. This design choice, operational independence, has genuine economic rationale. Central banks that can be directed by politicians to print money to fund government spending have historically produced inflationary outcomes that devastated ordinary people's purchasing power. The design is not without defensible justification, but it also means that the organization making the single most consequential set of ongoing decisions about American financial conditions operates with a degree of insulation from democratic accountability that no other institution of comparable power possesses. Understanding that insulation, what it is, why it exists, and what its limitations are, is the foundation of understanding why the Federal Reserve does what it does, and in whose interest it does it. If understanding the actual structure of the Federal Reserve just reframed something you thought you knew, stay with me, because the structure and the history are one dimension of this. The specific decisions the Fed makes, and exactly how those decisions affect your mortgage payment, your savings return, your job security, and the purchasing power of every dollar you earn. That is what comes next. And that is where this stops being history and becomes your current financial life. Let us get specific about the mechanism. The Federal Reserve's primary tool for influencing the economy is the federal funds rate, the interest rate at which banks lend reserves to each other overnight. This rate is set by the FOMC at each of its 8 annual meetings. It is not your mortgage rate, your credit card rate, or your savings account rate, but it is the foundation on which all of those rates are built. When the Fed raises the federal funds rate, every other interest rate in the economy tends to rise with it. When it cuts, they tend to fall. We covered the wealth transfer effects of rate changes in detail in our earlier video on this channel. How rate cuts tend to benefit asset holders, while wage earners experience the benefits later and less directly, and how rate hikes slow the economy, with the employment costs landing disproportionately on workers rather than capital holders. What is worth adding here is the layer that most people miss. The Fed makes these decisions using models and frameworks that were developed by economists whose primary professional experience is with financial markets and academic economics, not with the daily financial reality of a household living paycheck to paycheck. The way financial stress shows up in an econometric model and the way it shows up in someone's kitchen table math are not the same experience. And the distance between those two perspectives is built into the institution by its structure and its hiring practices. Now consider the Fed's role as lender of last resort, the function that was the original justification for creating it in response to the banking panics of the early 20th century. When financial institutions face liquidity crises, the Federal Reserve can provide emergency lending to prevent cascading bank failures. This function has genuine public benefit. A financial system collapse hurts everyone, and having a backstop reduces the probability of that outcome. But it also creates what economists call moral hazard. If financial institutions know the Fed will rescue them in a crisis, they have weaker incentives to manage risk conservatively in normal times. The 2008 financial crisis is the most recent and dramatic demonstration of this dynamic. Institutions that had taken on excessive risk received Federal Reserve support, while the households whose mortgages underpinned those risks lost their homes. Drop in the comments what you think the right level of Federal Reserve independence from political oversight should be. Full independence, more accountability, or something in between. The people who study this question professionally disagree significantly, and your perspective is worth as much as any economist's starting point on a question that is ultimately about values as much as technocratic expertise. Here is what understanding the Federal Reserve's actual structure changes about how you navigate your financial life. The first and most immediate implication is rate awareness. The Fed's rate decisions are public, announced in advance through a calendar of 8 annual FOMC meetings, and telegraphed through public statements from Fed officials in the weeks before each meeting. You do not need to predict the decision. You need to understand what each direction means for your specific financial position, as we covered in the rate cycles video. Fixed-rate debt holders are insulated from rate changes. Variable-rate debt holders are not. Cash holders lose purchasing power faster in rate-cut environments. Asset holders benefit. Knowing which position you occupy before each meeting is basic financial preparedness. The second implication is institutional literacy. When you hear news coverage of Federal Reserve decisions, you now have the context to evaluate what the coverage is and is not telling you. Who the Fed is accountable to, what interests are represented in its structure, and what the limits of its mandate are. These are not academic questions. They are the interpretive frame for the most consequential financial news that will affect your household in any given year. The third is the broader point about who designs the systems you live inside. The Federal Reserve was designed in 1910 by people with a specific set of interests. Those interests shaped the design. The design has operated for over a century. Understanding the design is not the same as being able to change it, but it is the necessary precondition for engaging with it intelligently, rather than experiencing its effects without comprehension. The Federal Reserve is not a government agency, in the way most Americans assume. It was designed by private bankers in secret, structured to give those banks a permanent ownership stake and a guaranteed dividend, and granted operational independence from the democratic accountability that governs every other institution of comparable power. Understanding that is not a reason for conspiracy thinking. It is a reason for clear thinking about who designs the systems that shape your financial life, in whose interests those systems were built, and how you navigate them with that knowledge. Share this with one person who assumed the Federal Reserve was just another government agency. And if you want to keep understanding the systems built around your money, subscribe to Hidden Truth Files. Hidden, no more.